A very good day to all of you. Today we'll be revising the standard in the 16 property, plant and equipment. The objective of this video series is to provide you a pilot view of the entire standard and help you revise it quickly, right? So we advise the students once you're done watching this video, you can go ahead and try solving the ICI problems, which will help you gain a lot of confidence, right? So without any further delays, let's get into the revision. The first important concept to understand in this standard is that what, according to IND 16, is property, plant, and equipment. The standard has very clearly defined that property, plant, and equipment means it has to satisfy some conditions. So only when a tangible asset satisfies this condition, it will fall under PPE under IND 16. And the various other principles that are there in the standard will apply to that particular tangible asset. So let's see what are those conditions. So the first condition is that the standard says that property, plant, and equipment are tangible assets which should be held for any one of these purposes. Which should be held for any one of these purposes. What are these? The first says that it should be used in production of goods. What do you mean by it should be used in production of goods? Let me give you a very simple example. Let's say you have a manufacturing unit, a unit for manufacturing electronic products, right? So that unit that you have, the manufacturing unit that you have, will have a lot of plant and machineries involved in them, right? Because for manufacturing electronic devices, obviously you will need a lot of machineries. So those machineries are tangible assets that are helping you in the production of goods and services. So does that satisfy the condition of IND 16? Yes, it does. Second, the standard says that it should be used in supply of goods. What do you mean by supply of goods? Let's go by the same example. You have a manufacturing units that manufactures electronic devices. Now, this electronic devices needs to reach its customers, right? So for that, for transportation, let's say you have some vehicles, you have some container vehicles. Now, these container vehicles are tangible assets which should be classified under IND 16 because they satisfy the condition that they are being used for supply of goods. The third condition in the same point is that it should be used for either supply of services. What do you mean by supply of services? Let's say you have a business process outsourcing unit, a BPO sector, right? You have a call center. So in that call center, obviously to provide services to the customer, let's say you are people who provide this back-end services. So for providing those services to customer, you will be using you will be using mobile phones, telephones will be used, monitor devices will be used, right? Headphones will be used. So all of these are going to be goods, right? Tangible assets, which are going to come under IND 16 because they help in the supply of services. So the first condition is that particular tangible asset should either be used in production of goods, either be used in supply of goods, or either it should be used in supply of services, right? The second condition is that it says that it should be used for rental to others. What do you mean by rental to others? That means the particular whatever tangible asset you have should be given as rental to the other party. But very important thing to remember here is that this is other than, this excludes land and building, right? Land and building has a very separate treatment which I'll be discussing just after this, right? So remember, it should be either used in production of goods, supply of services, or as rental to others, or for administrative purpose. What do you mean by administrative purpose? Now let's say obviously let's say you are a manufacturing unit, but still you will have your corporate office also, right? Where will your marketing team, your finance team, and all of these people sit? They'll not be sitting in your factory, right? They will be sitting in your corporate office. So now this corporate office building is being used for what? Administrative purposes. So will that come under IND 16? Yes, absolutely, because it is being used for administrative purposes. So if a tangible asset is being used for any one of these three reasons, along with one more condition. What is that one more condition? Is that that particular tangible asset should be expected to be used for more than a period. Should be expected to be used for more than a period. What is one period? One period is generally 12 months, but it is not anywhere specifically defined in the standard, right? Generally, one period means 12 months, but it can be either 9 months or 15 months, depending on the operating cycle of that particular business. So if a tangible asset is held for either use in production of goods, supply of goods, or supply of service, or it is being used as rental to others other than land and building, or if it is used for administrative purposes, and we expect that particular tangible asset is going to be used for more than one period, then it will fall under the definition of PPE under IND 16. Right? I hope the definition part is very clear. One more, as I told earlier, there's a special note that we are going to be discussing for land and building. that we'll be discussing for land and building. Now, whenever they give you land and building, you need to be very cautious. And first, you need to see for what is the land and building being used. If the property is being used for use in production, supply of goods, or supply of service, or it is used for any administrative purpose, any of these two, right? Either in production or it is being used for any administrative purpose, then that particular property will be treated as owner occupied property, and the treatment will be under IND AS 16, and the treatment will be under IND AS 16. But in case the land and building, that is the property, is being used for rental to others, that is you're giving it as rental to others on operating lease. But remember, one thing very clearly to remember here is, whenever I'm giving it as rental to others, the primary business of that particular entity should not be of doing this. Let's say my primary business is manufacturing electronics, but I have an ideal land. I don't want to put that land ideal, so I'm giving it for rental purposes. So is my primary business giving land and building, giving properties on rental purposes? No. Right, my primary business is that I'm a manufacturing entity of electronic devices, but I have an ideal land and building, so I decided to put that property on rentals. In that case, the income that you earn out of it is your investment income. Right, so that particular property becomes your investment property. Right, similarly, another case, when you're purchasing any land or building just for capital appreciation, solely for capital appreciation. What do you mean by that? Let's say I have a land near the airport, right, which is for 2 crore rupees, and I expect that in the next 10 years, as the airport expands, obviously this place will commercialize, so I will be getting a this land that I'm purchasing for 2 lakh has a potential of being sold in the future for around 10 lakh rupees. So, right. So in that case, the purpose of me purchasing that land was for either production? No. Was it for administrative purposes? No. It was solely to gain that capital appreciation. It was solely to gain out of that capital appreciation. So in case, so that means what? I'm basically making an investment, right? Because I'm expecting some higher return in the future. Right, so in that case, it will be treated as an investment property and it will be classified under IND AS 40. Right, first case, if it is rental to others, and that rental to others, you must remember that the entity's primary business should not be of doing that. Then that particular property will become your inventory, and it will be under IND AS 2. So this is where you need to play very carefully and try to understand what is the question asking you. Right, if the primary business is something else and then I'm giving on rental to others, it will be treated as investment property under IND AS 40. If the land or building is solely purchased for capital appreciation purpose, then again investment property under IND AS 40. The third is if there's an undetermined use, that is the land was purchased for no specific use. When I purchased the land, I did not think that I'll use for this purpose, that purpose. There was no specific use when I purchased the land. Right, I just had surplus fund with me, so I thought I'll put it on land. Right, so the land was purchased for some undetermined use. In that case also, it will be treated. So when you're purchasing something on an undetermined use, right, you're purchasing the land, but you don't have any immediate use, so obviously it is for some investment purpose, right? Future me, you will feel like I'll sell it and I'll earn from it, right? That cost difference will be my gain. So in that case also, it will be treated under IND AS 40, investment property. Right, so first we looked at the definition. The definition says satisfy any one of the 3 conditions, along with it should be expected to be used for more than 1 period. Second, special case for land, see if it is for either rental to others or capital appreciation, or if it is purchased for any undetermined use, then it will be treated under IND AS 40, investment property. Right, next let's see a small point from the ICI, which deals with treatment of spare parts and standby equipments. Now, spare parts are nothing but if you have a large machineries, obviously you will have a lot of screws, a lot of these bearings and small spare parts that will be there, right? Also, standby equipments in your corporate offices, you will have these fire extinguishers, right, which are very common examples of standby equipments. Now, we ask the standard IND AS 16, can I classify this spare parts and standby equipments under IND AS 16? Can I classify them as PP? The standard very clearly says, better look whether it satisfies the condition. I've given you the condition for definition, right? If it satisfies the definition condition, then you classify it as PP. Otherwise, it will be treated as inventory under IND AS 2. Otherwise, it will be treated as inventories under IND AS 2. Right, so the first concept dealt with only definition. So definition of PP under IND AS 16, we saw a special case for land and building, and third point we saw treatment of spare parts and standby equipment. Now going on to the next scenario, next concept is recognition criteria for PPE. Now I know that the PPE has satisfied the definition condition. The definition condition is satisfied by the PPE. Now whether I will recognize that particular PPE in my books or not will depend on further two conditions. The standard says there are two more conditions. The first condition is there should be some future economic benefit. Probable future economic benefit should be out of that particular property, plant and equipment. This is very basic, right? See, this is something very logical also. See, if I am going to purchase any kind of machinery or any tangible asset, why would I purchase it if I'm not expecting any future economic benefit? So obviously, right? So there should be some future economic benefit from that tangible asset. And second, the cost should be reliably measured. The cost should be reliably measured, right? Obviously, because I'm going to record it in my books, obviously I need to pass an entry for that. Some amount I need to give, right? So I need to be able to determine the cost of that particular property, plant and equipment. So the standard says that first condition for recognition is that there should be probable future economic benefit. And second condition is that there should be, the cost should be reliably measured, right? So if you are able to satisfy these two conditions, you can recognize the PPE in your books. Now let's suppose my PPE has met the definition condition. I'm also very sure that using this plant and machinery that I'm purchasing right now, let's say for example, I will be able to generate future economic benefits, and also the cost is reliably measured. Now I'm asking, initially for the first time when I'm recognizing this particular cost in my books, this particular PP in my book, in which amount should I recognize it? So the standard very clearly says the first time the initial recognition of PP will happen at cost. The initial recognition of PP will happen at cost, right? The initial recognition will happen at cost. So further, so the initial recognition will happen at cost, that you know, but there are three different case scenarios in which you can acquire the PP. First, they say that the PP is either self-constructed or purchased. That is, self-constructed means, let's say there's a machinery, you're building it all together yourself, right? Your entity itself is doing it, or you're purchasing it from outside. Second scenario is that PPE, that asset, is acquired on deferred settlement basis. What do you mean by deferred settlement basis? Settlement is basically making the payment, right? When I say deferred settlement basis, the payment is being deferred. The payment is delayed. The payment is being made on installment. It is not being made on one shot. So this is deferred settlement basis. Or either you are acquiring the PP on exchange of other asset. That is, I am giving up some asset and acquiring an asset. Some asset is being given up from me and some assets I'm acquiring. So first of all, the standard says initial recognition of PP will happen in cost, but it can come in any of these three situations, right? That asset can be either self-constructed or it can be purchased. That asset can either be acquired on deferred settlement basis, or I could have acquired that particular asset on exchange basis, right? Now let's see one by one each case. The first case says that in case the asset is self-constructed or purchased, very important thing, initial recognition will happen in cost. Initial recognition will happen in cost, right? And remember that the cost of the PP, this you would have already studied in AS also, the cost of the PP will include all the directly attributable cost. Directly attributable cost that was incurred to bring that particular property, plant and equipment to the present condition and location. All the directly attributable cost that was included to bring the property, plant and equipment to the present condition and location. One of the most important notes in this self-constructed and purchase, if you look at some of the ISM problems, they would have given, let's say there was a self-construction, a building was being constructed, okay, and obviously if it's a building going to be constructed, I will not be able to construct it in 1 or 2 days, right? It is going to take me, of course, some months or couple of years. So in that time span, what do I think is the ground floor of the building, of course, because the first floor or the second floor construction happening, the ground floor of the building is quite idle. So I think that I can put that the rest of the land area which is there in that particular thing, except for the building construction, I can use that for parking services. Now, if I'm going to be using that for parking services, obviously I'm going to generate some revenue out of it, correct? Obviously, people are going to park their vehicle. I'm going to, charge them something, right? So I'm going to generate some income out of it. Now, I am asking the standard, can I adjust this income with the cost of the PP? What am I asking the standard? This incidental income that I have earned by using this particular land as parking area, can I adjust this incidental income with the cost of the property, plant and equipment? The standard very clearly says no. The standard very clearly says, no, you cannot do any such adjustment, because the incidental activity had nothing to do with the construction of the building. If you did not give that rest of the part of the land for parking services, would the building construction have stopped, or would that have been affected? Absolutely no. So this was incidental to that. So that incidental activity, say whatever income is being generated, that will be taken to your P&L. You cannot adjust that to the cost of the PP, right? Very, very clear. In some questions, you will see the scenarios coming up. So in that case, you should be very clear that it is an incidental income, has nothing to do with the PP. Hence, you cannot adjust the cost of the, you cannot adjust the incidental income with the cost of the property, plant and equipment, right? Now, what does the cost of PP generally include? See, this list is of course not exhaustive, right? There are a lot of other things in your ICI module, but broadly, the cost of PP, as you know, will include the purchase price, right? If there are non-refundable taxes, that will be included. If it is refundable taxes, then obviously it is not my cost. Ultimately, it is actually no cost for me, right? So if it is non-refundable taxes, I will not include it, but refundable taxes, yes, I will be, sorry, if it is non-refundable taxes, I will include it to my cost. If it is refundable, I will not include it to my cost, because it is not my cost at all, right? And any other cost that you will be that you have incurred to bring the particular property, plant and equipment to the present condition and location will be included to the cost of PP. Next is, in case you estimate that there's going to be, this is a very important note, in case you estimate, the cost of PP will also include the estimated dismantling, estimated removal or estimated restoration cost. Now, what is all of this? Now, let's suppose let's say you have a land, right? And you have a building in that land, and you have taken that land on, let's say, on rental purposes, rental agreement, right? And the owner says that you can use that land for 10 years, but after 10 years, when you return that land to me, that land should be in the same condition that I gave you right now, because now the land does not have the building, right? So after 10 years, in this 10 years, if you want to construct a building, you want to do whatever with that land, you do, but after 10 years, when you give that land to me, it should be in the same condition that you have, that I have handed over it to you right now, right? So what will you do? So after 10 years, you will have to incur some expenses to bring that land to the present condition, right? To hand it over to that owner. So in that case, I estimate that after 10 years, after this lease period is over, I need to give, like, let's suppose I need to incur 10 lakh rupees to bring that land to the present condition. So what will I do? That also today will be included in the cost of PP. Of course, you will PV it, you will present value it, and include the 10 lakhs to the cost of PP, which slowly, year by year, in the first, second, third, you will start unwinding it, right? In detail, you would have discussed this in the class, right? And you have a lot of illustrations also in your ICI, which helps you understand this concept. I'm just trying to revise it, right? So what you will do, if you know after 10 years there's going to be some dismantling, some restoration, or some removal cost that is going to be incurred, today its present value will also be added to the cost of PP, and slowly that present value you will start unwinding it over the period of the asset, right? And in case there's any trade discount or rebate, you will reduce it. But in case there's any cash discount, that will not be adjusted to the cost of PP. Why do you not adjust cash discount to the cost of PP? Because cash discount are basically early settlement incentives that are being given. Cash discount are basically early settlement incentives that are being given, that has nothing to do with the cost of the property, plant and equipment. Similarly, in case you have incurred any staff related cost, like staff training cost or staff relocation cost, or any such cost, that cannot be included to the cost of PP, because for the very simple reason saying that the property, plant and equipment was ready, the machinery was ready, but the people, the skilled people to operate that machinery weren't available in your organization. So you had to conduct some training to the existing employees to train them on how to use this machinery. So the standard says my machinery was very ready, very much ready, right? Just because you did not have these skilled employees, and because of which you had to, give them a special training, and for that you have incurred a cost, that clearly does not mean that I will include that in my cost of machinery. So in case you have in case you have incurred any staff training or reallocation of employees, because let's say my factory is in Jaisalmer, but the employees who are capable of, operating those machineries are present in Bangalore. So now I need to shift those employees from Bangalore to Jaisalmer. So there's some reallocation cost that will be incurred, right? So that cost, can I add it to the cost of the PP? The standard says clearly no, because the machinery is ready, but skilled labor are not there. That is not my problem, right? But is the machinery ready for its intended use? Yes. right? So where once the machinery is ready for its intended use, you will not add any other cost to the cost of the machinery. So that will also not be added. Next is any advertisement related cost, like you are having an inauguration ceremony, you are having an opening ceremony, any other advertisement marketing you're doing for that particular branch or something, those costs and all you can't add to the cost of the pp, because that does not affect the pp, right? The pp is ready for its use. Just because you want to promote or you want to market your particular product or your outlet or anything, your pp basically, that does not mean that you can add the cost incurred for those to the cost of the property, plant and equipment. Similarly, any maintenance cost, you have this day-to-day repairs and maintenance happening, annual maintenance contract, operating losses that you incurred, all of this cannot be adjusted to the cost of pp. So basically the standard says at the point where the property, plant and equipment is ready for its intended use, you will stop recognizing any other cost. You will stop recognizing any other cost. Similarly, this is an important point. It says that in case you have taken any interest, you have taken any loan, right? You have taken any loan to acquire that pp, and for that loan there's an interest, obviously, right? So will that interest cost be included in the cost of pp? The standard says, here the standard does not clearly deny it. The standard says, wait, look at whether that particular loan satisfies the condition of Ind AS 23 borrowing cost, right? In AS 23 we'll be discussing. So if the standard satisfies, if that loan that you have taken satisfies the condition of Ind AS 23 borrowing cost, then that interest for that particular loan can be added to the cost of pp, otherwise no. Now what is the condition of Ind AS 23, we'll be discussing in that particular standard, right? So it is very important. So clear cut, the standard does not say no for interest taken on loan, right? If interest is taken on loan and that loan was used to acquire a pp, then we will see whether the pp, whether that loan is satisfying the condition of borrowing cost under Ind AS 23. If not, then it will not be added to the cost. If it is satisfying, it will be added to the cost of property, plant and equipment, right? That was case number one, when your asset was acquired on either self construction or on purchased, right? Next is when your asset is acquired on deferred settlement basis. As I told earlier, settlement is basically payment being made. And what do you mean by deferred settlement? That the payment is being made in installments, deferred, the payment is deferred, right? Delayed. So when the payment is being made on deferred settlement basis, obviously, let's suppose you go to a manufacturer, you would go to any of your vendor, and you say that you give me the raw material, I'll pay you after 1 month. Okay, and let's say the raw material costs you 10 lakhs. You think the vendor will ask you to pay the same amount, 10 lakhs after 1 month? No, he will tell you have to pay some extra. He will tell you have to pay 10 lakh 50,000. So that 50,000 that you're paying extra is basically your interest cost. It is basically interest for the delayed payment that you're making, right? So that is not part of the cost of the pp. That is not the normal purchase price of the pp. What was the normal purchase price of the pp? 10 lakhs, right? What was the normal purchase price? 10 lakhs. But you said that I will make a deferred payment. So he said, okay, make the payment after 1 month, but you need to pay 10.5 lakhs. So that 0.5 lakhs that you're paying is basically your interest bit. So it will ideally, it should be taken to what? Your P&L. It should be taken to your P&L. It's your finance cost, right? So the standard also says the same thing. So in case the payment is being made for that asset on a deferred settlement basis, then Baba, what you're paying extra is basically not the amount you're paying for your PP. It is the amount you're paying for that deferred settlement arrangement that you're doing. So that is basically your interest cost. That is basically your finance cost. So that finance cost will be taken to your P&L, right? And this 10 lakhs ideally is the cost of the property, plant and equipment. It was the standard says. Now there's one more very interesting thing that you will observe in some of the questions in the ICI, right? Which is that they will not give you the purchase price of that asset directly, right? They will tell that you're paying 5,000 in 3 installments, right? So if you are paying 5,000 in 3 installments, then obviously from here itself you can find out the payment is being made on a deferred basis. So this is asset acquired on a deferred settlement basis. So now here, when asset is acquired on a deferred settlement basis, obviously, so you're paying 5,000 in 3 installments. So obviously how much you will be paying? 15,000. So now this 15,000 will have 2 components, right? And they tell that the discounting rate is 10%. The question also tells the discounting rate is 10%. Now this 15,000, is it the price of the PP? The answer is absolutely no. It is not the normal purchase price of the PP. The 15,000 has 2 components to it. The first component to that is the normal purchase price. normal purchase price, right? And the second component is the finance cost. The second component is what? The second component is the finance cost, right? So this is a very important thing that the standard says. So the standard says, so that in case in questions that you observe that 15,000, let's say they tell you 5,000 is being paid in 3 installments. So obviously that 15,000 is not the entire amount of the PP. In that, some amount is going to be a finance cost, some amount is going to be the normal purchase price of the PP. Now, how will I find out which is the normal purchase price and which is the interest amount? Very simple. They would have given you discounting rate for that only. So if you discount 5,000 at 10%, okay, for the first month, you will get a portion. You will get the portion which belongs to the normal purchase price, and you will get the portion which belongs to the interest for the first year. Similarly, second year, 5,000 being made, 10% you will discount it, but for 2 years. Again, you will get the portion which belongs for first year's normal purchase price, second year's normal purchase price. Similarly, third year you will do. So the total of these 3 years will become the total normal purchase price, and the total interest part will become the total interest for 3 years. That way. So you will get more clarity on this when you try solving questions, right? But this is something you will very commonly observe, that the question will not give the normal purchase price directly. So in that, you need to use this discounting rate and find out the normal purchase price. Next is the third scenario. In case the property, plant and equipment is acquired on an exchange basis. What do you mean by an exchange basis? That is, some asset is being given up by you, okay, and some assets are acquired. You're acquiring some asset and in return you're giving up something. So when this happens, this give and take happens, right? In that transaction, it is very important that you should first check whether the transaction has a commercial substance or the transaction does not have a commercial substance. So the question here will be, what is commercial substance? Because only when I know what is this, I'll be able to check in the transaction whether there's a commercial substance or not. So for that, commercial substance is nothing but if a transaction is going to affect the cash flow of the entity, that transaction has a commercial substance. And if there's a transaction that is not affecting the cash flow of an entity, then that transaction is not having a commercial substance, right? Let me give you a very simple example. Let's suppose this exchange, let's take the same example, exchange of these goods are happening, sorry, of machineries are happening, okay? So you are having a machinery which has the capacity to produce 1,000 units. And you are exchanging that for a machinery which has a capacity to produce 2,000 units. So in this exchange transaction, is there a commercial substance? If I ask you, your answer should be absolutely yes, there is a commercial substance. How there's a commercial substance? Because see, earlier I was producing 1,000 units. Now I'll be able to produce how many units? 2,000 units. So how many units surplus? 1,000 units surplus. So the 1,000 units surplus, 1,000 units surplus will be sold in the market. So surplus revenue generation. So is it affecting my cash flow? Obviously, yes. So this transaction has a commercial substance? Yes, it has a commercial substance. Right, now look at the another scenario where a transaction does not have a commercial substance, right? Let's take, for example, there are two godowns, godown A, godown or warehouse, whatever you want to call it, warehouse A and warehouse B, right? So A is owned by, let's say, Mr. A, and B is owned by, let's say, Mr. B, right? Now both of these transactions, okay, both of these people are coming into an arrangement that they will exchange their warehouses. They will exchange, the warehouses are located in the same area, just adjacent to each other, and they decide that we will exchange the warehouses. So previously, A's goods were being stored in A warehouse, but now A's goods are going to be stored in B's warehouse. Is that going to in any way affect A's cash flow? Obviously not. So does this exchange transaction have a commercial substance? No, this exchange transaction does not have any commercial substance. So you understood? So whenever an exchange transaction is happening, it is very, very important for you to check whether the transaction has a commercial substance or the transaction does not have a commercial substance. If the transaction has the commercial substance, the asset that is being acquired means I'm acquiring an asset, right? I'm getting the asset. So its amount should be recognized in the book in the following order. First, you need to see whether you can find out the fair value of the asset acquired. The asset that you are acquiring, whether are you able to find the fair value of that particular asset? If yes, then that asset will be recognized in the fair value. If the fair value of the asset is not being able to be determined, then you will see whether the fair value of the asset given up you are able to find out. If that also you are not able to find out, then the carrying amount of the asset that is being given up. Then the carrying amount, then the particular asset that will be recorded in the carrying amount that is of the asset that is being given up. Right? In case the transaction has commercial substance, in the following order, you need to see whether you can record the asset. First thing, you will see whether you can find out the fair value of the asset that is being acquired. Second, you will see whether you can find out the fair value of the asset that is being given up. Both you are not able to determine any of the fair value, either of asset acquired or given up. Then you will go for the carrying amount of the asset that is given up, which will obviously be present in your books. Right? Next is, if the transaction lacks commercial substance. If one was the transaction has commercial substance, here if the transaction lacks commercial substance, you simply have to record the asset acquired in the carrying amount of the asset given up. The carrying amount of the asset given up, right? Excuse me. Next is a special note. What is a special note for? In case, along with this exchange transaction, some cash is also being exchanged. Along with this exchange transaction, some cash is also being exchanged. In that case, what you will do, that is, I'm giving up some of my asset plus some cash, or I'm receiving asset plus some cash, right? Either ways, anything is happening, then how we will do? In case cash is either paid or cash is received along with the exchange of assets, what you will do, in some if some amount of cash is paid, that is, I'm paying some amount of cash and giving my goods also, right? So giving my goods, let's say worth 10 lakhs, and I'm giving 2 lakhs in cash. So totally how much I'm giving? 10 lakhs. So in that case, what you will do, the asset that is being acquired is worth how much? 10 lakhs plus this 2 lakhs that I'm giving. Because why will I give extra cash? Because I think that asset is worth that much. So 10 lakhs plus 2 lakhs. 12 lakhs is what the asset is being given, asset is being acquired for. Right? So then what they're telling, this cash amount should also be added at the asset. Similarly, you're receiving an asset. Yeah, you have received asset along with some cash. So in that case, what you will do, you have received an asset along with some cash. That particular cash will be deducted to arrive at the amount. That cash that you are receiving is going to be deducted to arrive at the amount. Right? I hope that is very clear. One was, the first case was, we were simply seeing the principle in case exchange transaction happens. The second case, in case exchange of goods are happening. Yeah, assets exchange is happening along with cash is also being traded. Right? There's transaction of cash along with transaction of asset. If both of these are happening, how you're going to handle is what we saw in this special note. Right? These are all, these special notes are basically what you will see in your questions. Right? More of question oriented, what you will see. Concept, we have learned concept was this. Now in this question, you will see additionally dealing with cash also. So then how to treat it, I have just given you a small briefing. Next is, in some questions, they ask you explicitly in this exchange transaction. Of course, in case you are coming under the third scenario, that is calculation of profit or loss on exchange of asset. Asset is being acquired in exchange of other assets. In that case, in the question, sometime for a single mark or 2 marks, they'll tell you to find out in this overall transaction, what was the profit or loss. In this exchange transaction, what was the profit or loss? To find out that, what you should simply do is, it's a very simple thing. You need to first find out the value at which the asset is acquired. Asset that is acquired, it is recognized in which value, that you find out. Then, in case any cash is being received or cash is being given, if cash is received, you add it. If cash was given, then you deduct it. Right? So that will give you the total amount of the amount at which the asset was acquired. The asset was acquired. Now this you will compare with the carrying amount of the asset that is given up. This you will compare with the carrying amount of the asset that is given up. Now if this is greater, that is the amount at which the asset is acquired is greater than the carrying amount, then obviously it's a profit scenario. Or if it's the other way around, the carrying amount is greater than the amount in which the asset is acquired, then it is a loss situation, right? So this is a simple table to calculate that profit or loss, right? Next, a very simple concept, right? A concept that you know very well, depreciation, right? How you will charge depreciation for assets under IND AS 16. The first most important thing is the methods of depreciation that are available to us, right? You yourself know there are various methods, right? Broadly, I would say straight line method is there. There's the diminishing or the reducing balance method. And the most famous is the production units method, right? So can I apply any one of this method according to my wish? The standard says no. the method that you choose, that you're going to apply, should be in par with the pattern in which you expect that the future economic benefits are going to flow from that particular asset, right? If it is a machinery, then the most suitable way, if a machinery, if it's a production machinery, and the most appropriate way of charging depreciation will be charging depreciation on production of units method, because on the basis of production of units only I'm trying to recover the future economic benefit from that asset, right? So the standard very clearly says that the depreciation method that you are adopting should reflect the pattern in which you are expecting the future economic benefit to flow from that particular PP, right? And this depreciation method should at least be reviewed every year, once every year, so that in case any changes are required, you will get to know, right? So once you set a particular method, it does not mean that will continue forever. So you have to review it every year to see whether it is appropriate even now. Next point says that depreciation on PP begins when the asset is ready for use and not when it is put to use. Very, very easy, right? Very easy as well as logical, right? Once the asset is ready to use, from that date, depreciation will be charged. The put to use concept is not there. You might have the asset is ready to use, on 1st of January, but you're putting it to use on only September. Then does that mean for that particular 6 to 7 months, I will not charge depreciation? No, you have to charge depreciation, right? For the 9 months, will I not charge depreciation? Obviously, I will charge depreciation, right? So the ready to use concept is being used. So once the asset is ready to use, from that date, the depreciation will charge, and the depreciation will cease on the day the asset is getting derecognized. What do you mean by derecognized? The asset is getting sold. So on the day the asset is getting derecognized, or it is being put as held for sale under Ind AS 105. Discontinuing operations, right? Under Ind AS 105, if you're putting it for held for sale, or if it is derecognized, if it is sold, on that day, the depreciation will cease, right? You will cease the depreciation for that particular property, plant, and equipment. Next, a very simple point. In case of change in method of depreciation, the useful life of the asset, the residual value of the asset, any of these changes will be considered as change in accounting estimate. Any of these changes will be considered as change in accounting estimate, and a prospective effect will be given. And what effect will be given? Not retrospective, prospective. So further onwards, that effect will be given. You need not go to the previous balances and keep changing them, right? A prospective effect will be given, and they will be treated as change in accounting estimate. Right. Next is the compound accounting method. What is the component? Sorry, not compound, component accounting method. Now, what is a component accounting method? In case you have a in case you have a PP that has a significant part, then the standard says for that significant part, the depreciation will be calculated separately, right? Let's suppose I say I have a car which is for 10 lakh rupees. I have purchased a car, and the engine of the car itself is for 4 lakhs. So the engine is a significant part of that particular PP that I have, right? And the engine has a useful life of 5 years, whereas the car has a useful life of 10 years. So now 6 lakhs, so 10 lakhs is for the car, out of which 4 lakhs pertains to engine. 4 lakhs pertains to what? Engine, right? So now, and the useful life of this engine is 5 years, and the useful life of this car is 10 years. So the standard then says for that significant part, depreciation will be calculated separately, and for that other part, depreciation will be calculated separately. In component accounting, even let's say in a building, you would see very common example, building, there's a lift. The lift is a significant component of that building, and the significant component's depreciation will be calculated separately, and the building's depreciation as a whole will be calculated separately, right? But in case the standard says if the useful life of the component, the significant component as well as the PP as a whole are the same, then why are you going for calculating the depreciation separately? That time you can calculate it as 1. Obviously makes sense. If the engine also has useful life of 10 years, and the car also has useful life of 10 years, why would I go calculating both of them separately? That time, yes, I can calculate it together, right? Now, another important thing. If any of this significant part, now you know what is a significant part, and the standard says that significant parts depreciation will be calculated separately. Now, in case any significant part is getting replaced, then what will I do? The standard says very easy. You have the carrying amount of that asset. Yes. In that carrying amount of the asset, add the cost of the new part and de-recognize the cost of the old part. Add the cost of the new part and de-recognize the cost of the old part. Let's say a very simple example. 10 lakhs is the car, and in this 10 lakhs is the amount of the car. In this 10 lakhs, 3 lakhs pertains to the cost of engine. 3 lakhs pertains to what? Cost of engine, right? Cost of engine, which is the old engine. So this 3 lakhs, the standard say de-recognize it, reduce it from the cost of the asset, and the new engine you have purchased for 5 lakhs. Now add that new engine's cost to the cost of the asset, right? Add that new engine's cost to the cost of the asset. So the standard says, in case the significant part is being replaced, the new parts cost will be added to the carrying amount of the asset, and the old parts cost will be de-recognized from the carrying amount of the asset. So you will arrive at the new carrying amount, right? That is what the standard says. Now, next case. In case of the carrying amount of the old part is not given in the question at all. So the carrying part itself is not been given in the question. How can I calculate? It is very simple. What you do is you will have the cost of the new part, right? Obviously, the cost of the new part will be given to you in the question. So take that cost of the new part, and then you have to present value it to the date of installation. So present value it to the date of installation. Let's say 5 lakhs is the cost of the new part, and that 5 lakhs, that is being replaced now to an engine which was purchased 5 years back. So it was purchased 5 years back, and the discounting rate is 10%. So now present value it for 5 years at 10%. So the value that you get for this 5 lakhs, when you present value it for 5 years at 10%, that particular value will become the cost of that old part 5 years back. And now for that cost, you will calculate depreciation and bring it into today's value, right? This will be more clear when you solve the question. This is just, I have given it as a note for you. Right? Once you solve the question, you'll have a better understanding. So in case the the old parts cost is not given to you, no worries. You have the new parts cost. You will present value it to the date of installation of the old part, and then deduct the depreciation from that present value, so that you can arrive at the old parts cost on the day of replacement. Old parts cost on the day of replacement, right? So this is all about component accounting. The next concept is concept of subsequent recognition. Concept of subsequent recognition on balance sheet date. Now the standard says, I told you initial recognition will happen in cost, right? I told you that initial recognition will happen on cost. So, but the subsequent recognition, the standard says, can either be on cost or revaluation model. That depends on you. Whatever accounting policy you want to use, either cost or revaluation model, that is up to you. But once you have selected the model, either cost or revaluation, that will apply to the entire class of asset. That will apply to the entire class of asset. What do you mean by class of asset? Class of asset means assets which have a similar nature. Assets that have similar nature, right? So the standard says the subsequent recognition can either be on cost or on revaluation model, and it is up to you to decide whether you want to go for cost or revaluation. But once the accounting policy is being chosen, then that particular accounting policy will apply to the entire class of asset, right? Entire class of asset. Now, what is the cost model? It's a very easy model, right? It says cost less you will, you will eliminate all the accumulated depreciation, and if you eliminate all the impairment loss, you will arrive at the cost of the asset. Under the revaluation model, it's nothing but the fair value of the asset on the date of revaluation. The fair value of the asset on the date of revaluation, right? In case of revaluation, subsequent depreciation, like let's say today I'm revaluing the asset, right? And I get a revalued value. And now this revalued value will be used for subsequently charging the depreciation for that asset, right? Which is very, very important and you need to remember. Next, there's a small concept, right? In case of revaluation model is being followed, right? In case the depreciation is being charged directly on that particular PP itself, that is PP, that means PP is being maintained at a net value, that is gross less depreciation, net value is being maintained. So in that case, in case there's a revaluation profit or revaluation loss, that will be directly adjusted with the PPE itself. That will be directly adjusted with the PPE itself, right? So you can see the entry here. treatment in case of revaluation gain. In case the fair value is greater than the net carrying amount, that means you have a profit. There's a gain situation. In that case, you can directly adjust the PP to the you can adjust the revaluation gain with the PP. And in other case, where the fair value is less than the net carrying amount, in that case also there's a loss. So this entry is wrong actually. There's a loss. So that loss also can be directly adjusted with the PP. How you will adjust it with the PP? Revaluation loss account debit to PP, right? So you can directly adjust it with the cost of PP. But in case you're following the provision for depreciation method, that is depreciation is being accumulated in a separate account. So the book, that is the PP will be at cost. It will not be at its gross value. It will be at cost, and the accumulated depreciation will be in a separate account called provision for depreciation account. So in that case, if a revaluation gain or loss comes, the standard very clearly says first adjust this accumulated depreciation with the cost of the asset and bring that asset to the net carrying amount. Once you bring the asset to the net carrying amount, then you do the same treatment as you do here. Then you do the same treatment as you do here. So the first thing is adjusting that accumulated depreciation with the cost of the asset to bring it at net carrying amount, and then the treatment will go as earlier itself. Right? Next, the last concept of this particular AS is treatment of revaluation gain and treatment of revaluation loss. So in case you're doing a first time revaluation, right, and you get a revaluation gain, the gain will be taken to revaluation surplus, right? You will credit the revaluation surplus, and in case there's a loss, then that loss will be taken to the debit side of P&L. And the loss will be taken to the debit side of P&L, right? Now, in case of subsequent recognition, there can be two cases. You either have a gain or you either have a loss. Now, if you have a gain, let's suppose, the most important thing to check is whether in the previous year there was a gain or a loss. If in the previous year there was a gain, then this gain will also be taken to OCI. But if in the previous year there was a loss and current year there's a gain, then what you will do, it is very, very important and interesting also. See, previous year there was a loss. So when there was a loss, what you would have done? You would have taken that loss where? The P&L. So the standard is telling now if you have a gain, equivalent amount, you take the gain also to the P&L, and except that you take that to your revaluation surplus. That gain also, because last year you had a loss, you try to offset it with the gain this year. And if you have any surplus gain, then you take it to your revaluation reserve. Then you take it to the revaluation reserve. Similarly, in case you have a loss in the current year, subsequent recognition is being done and there's a loss. Now see whether in the previous year there was a gain or in the previous year there was a loss. If in the previous year there was a gain, right? Previous year there was a gain, what you would have done? You would have taken it to your OCI. You would have taken it to your OCI. Yeah, you would have taken it to your revaluation surplus. This year, what do you have? You have a loss. So the standard is telling to the extent of the loss, debit your revaluation surplus account. To that extent of that loss, debit your revaluation surplus account. If there's excess of loss, even after adjusting, then you take that to your P&L. And if there was a loss in previous year and this year also if there's a loss, you have no other option. This year's loss also will be directly taken to your P&L. Right? I hope you have an understanding of this, right? A better clarity of all of these concepts you will gain once you start solving the questions. So this was the broad understanding and a pilot revision of IND 16. We have tried to cover all the major concepts, all the major concepts of this chapter that you need to know to be able to solve the questions. So once you're done watching this lecture, we would highly recommend that you go and try out the ICI problems, which will help you gain a lot of control and mastery over this particular standard. Thank you so much.